Hello, hello, hello. This is week 2 of the Credit Ready program. Today we're going to be talking about the basics of credit. So I have so much to cover that I will not have a chance to wait on everybody. This should be recorded inside the Facebook group, and hopefully this is going to be recorded on my YouTube channel as an unlisted video, and that way I can send it out. But I won't know until at the end, because this is my first time doing a video unlisted in my streaming platform. So let's go ahead and get into it. I hope some more people come in, but if not, like I said, I will try my best to send it out to everybody that's not able to be here on the live. So as I said before, we are in week 2. We're going to talk about the basics of credit, the modules that we're going to talk about. Of course, you should have gotten your presentation slide videos that I've made. You should have got 4 in the email that probably went out Sunday. And so today I'm going to go over those. And so we're going to be talking about what is a credit score, why does it matter, factors influencing your credit score, and then we're going to talk about how different debts affect your credit, the cost of bad credit, and that's how we're going to end today's live. So I'm not going to get into the wealth reflection journal prompts and all that. If you looked at the video, then you know what my credit story is. So we're going to get into the actual lesson. So I hope you all can see my board. I was trying my best to adjust it where it did not have a glare, but I don't look like I did it any good. So I'm going to try my best to I'm just going to read it off to you. So up here it just says, what is a credit score? So first of all, before we know what a credit score is, we need to know what credit is. So credit is the ability to borrow money. So what is a credit score? Knowing that credit is the ability to borrow money. Well, a credit score is a formula that takes behavior data and they calculate that data, and that's how they look at individual risk of defaulting on a credit product. So your score is going to calculate what is the risk of you defaulting on this credit. Okay, so that is what a credit score is. Now, reporting agencies, and it's been many of them, and there still are many of them, have been around since the 1800s. Now, depending on your ethnic group, if you had access to credit before the 80s. So just depending on your ethnic group. But reporting agencies have been around since the 1800s. Now, we know the big 3 reporting agencies, which we call credit bureaus: TransUnion, Experian, and Equifax. Now, Equifax has been around since 1899. TransUnion been around since 1968. Experian used to be TRW in 1968, but then TRW sold it in 1996 and it became Experian. So these are the big 3, but there are many of them out there reporting agencies. Okay, so when we look at these credit reporting agencies, they are a business. Okay, and that's probably how you got to the Credit Ready program, is me talking about in that video about how we need to separate banks and credit bureaus to think that they're not for us. They are businesses. So the credit bureaus or credit reporting agencies, biz, that tracks and store data provided by lenders and other consumer reporting agencies. So they track data that was given to them. Now, when we talk about what is a credit score, now credit scores are generated by different agencies, as I said. But you don't have just a credit score. You have several credit scores, okay? There has been hundreds of credit scores. You wouldn't believe how many credit scores you have. So with that being said, we really can't say for sure what your credit score is, because depending on what the lender is looking for is what they're actually going to get. And we don't know what the lender is requesting. because let's do a money trail. So the FICO score is a scoring module that uses consumer past behavior to predict future outcomes, and this score has been around since 1989. Bill Fair and Earl Isaac, they started this firm in 1956. In almost 30 years, about 30 years, they were trying to convince the banks, the lenders, to use their calculation, their formula, instead of them using their current database. So a lot of the lenders back then, they were just using what they knew from their current customers. Okay, so say if I got a loan from them and my neighbor got a loan from them and my other neighbor got a loan for them, it was a small community of people that they were actually basing their lending practices on. But Bill Fair and Earl Isaac was like, hey, we need to come up with a formula that will not be biased. And it won't be biased on religion, race, ethnic group, gender, all of that. We need something that will not cause any type of bias, okay? So 30 years it took them, but finally the FICO score was established in 1989. So the FICO score has been the most popular score, as we all know, but because the credit bureaus right here, the big three, they decided that they want to give FICO, who is the largest, some competition. So they teamed up to create the Vantage 3.0 in 2006. So Vantage 3.0 came out in 2006. Now, they will say that, no, we're not better than FICO. We haven't tested it side by side, but as an alternative. But really and truly, here's the thing. As I was saying, let's follow the money. So these are businesses. So when a lender, I'm gonna use my blue one on this. Okay, so when a lender orders a credit score, we say pull your credit. But really and truly, what they're doing, they're going to one or all of these credit bureaus. So the lender is either pay for a TransUnion, they either pay for Experian, or they pay for Equifax, or they might pull all three, or they might pull two, whatever their lending rules and practices, depending on what they pull. Okay. So with that being said, the lender will order a score, a FICO score. Now, in order to get that FICO score, they got to go through the credit bureau. So through the credit bureau has to then go to FICO and get the score. Now, let's follow the money. The lender buys it. The lender buys it from the credit bureau. The credit bureau then buys it from FICO. So the lender buys it from the credit bureau buys the FICO score from FICO. So this is the money trail, okay? Now, how does that get back to us? So I guarantee you that if the credit bureaus are buying FICO scores, when the lender pays for the credit bureau score, for the credit bureau to get this score, the credit bureau then is going to turn around and pass that back to the lender. They're going to pass all this cost back to the lender, right? And what the lender's going to do is pass that cost back to the consumer, back to us, back to the person that's getting the loan or getting the credit card or getting the whatever that you're applying for. So the lender gets a bill at first from the credit bureau then gets the credit score from FICO charges them for said credit score, and then all that passes back to us. So that's the money trail, right? So with that being said, that's how Vantage 3.0 got started, because they wanted to cut out the three big major credit bureaus, wanted to cut out the FICO, because if the lender goes straight to them and says, hey, I need a credit score, and they use the Vantage and not the FICO score, well, then the credit bureau, depending on what bureau that they want, either way, they, all three of them, created the Vantage. So they're able to keep that money in their pocket instead of having to give some of it to FICO. So you always want to follow the money when it comes to business, because at the end of the day, credit is business. Credit is business. No matter how you slice it and dice it, it's big business too, because they make money off of us in the form of interest, in the form of origination fees. This is another way they can pay for this credit check and FICO score, through origination fees, through interest rates, through application fees, all types of fees that they can throw in to try to get their money back from ordering these scores from these different businesses, from the credit bureaus, and the credit bureaus ordering the score from FICO. Now, the reason why Vantage 3.0 has not taken more preference over FICO is because, as I said, FICO has been around since 1989. So a lot of the businesses, a lot of the lenders, they have the FICO score already in their system. You know, they've already implemented it in all their lending practices. So when they first got the FICO score in whatever bank that might have been around forever and a day, it probably cost them upwards of $100,000 to implement FICO whenever they decided to use credit scoring instead of all the many different ways that they was using to approve people for loans prior to actually getting a score. Okay, so with them getting the score now from FICO, they've already got their systems tied in with FICO. So for them to go to Vantage 3.0, it will cost them a lot of money and a lot of time and a lot of implementation to change their system over to do this. So that's why, even though this has been around since 2006, it's not taking over FICO, because it costs the banks and the lenders too much to switch over. Now, some have, but as we know, 90% of the US especially still uses FICO and do not use the Vantage score. But that could change. That could change. In week 5, we're going to talk about the new FICO module that's coming out. Well, it's actually already out. Because Fannie Mae and Freddie Mac, and I think it was in October of last year, October 2022, I think it was, that they, have implemented it in some of their lending. They have okayed it, and because they are the biggest mortgage people, then everybody else eventually will follow suit. But they also they implemented the FICO 10, 10T, and then the Vantage 4.0. That's the one that they also looked at as well. So it could be that this may run neck and neck with FICO in the future. We don't know. But for now, a lot of people do not want to switch over because it's going to cost them a lot of money to change their lending practices, as well as just getting all that systems set up. That's a lot of money, okay? So when we talk about the credit score again, and I told you that there are several credit scores, and I'm looking at my notes right here. Let me give you an example of what I mean by several credit scores. I should have kept that up there. So So as of now, Equifax and TransUnion both have 13 different FICO scores. They have 13, and Experian has 14 different FICO scores. So there, when you're looking at your credit score on whatever app or whatever you're looking at, you will not know unless you get denied what your credit score is, because they have to send you your credit score in an adverse action. And you may look at what they say your credit score is and why they denied you credit. And then you're looking at your app and be like, this is off, because we don't know which one of these scores they're pulling. Even me as a YouTuber that tell you, okay, they're pulling from TransUnion, I can't tell you if they're pulling the FICO 8, because they could be pulling the FICO 8. They could be pulling the bank card 8. They could be pulling, several different ones, 13 different ones, 14 different ones. I don't know. All I can tell you is from my experience, they pull from this credit bureau. What credit report that lender is going to pull can vary from person to person. So we have no idea. So the only way to make sure that we can get approved on all of these different FICO scores is to make sure that we're doing the top 5 things. And the top 5 things are, number 1, payment history. We got to make sure that our payment history is always on time. Always on time. No way around that. Always on time. And number 2 is our utilization of credit. So we know that they look at credit utilization as 30%. Now, we always talk about the revolving when we talk about credit utilization. Is your credit cards, your revolving is your credit cards, your overdraft protection, and your HELOCs, your home equity loans, or your PLOCs, your personal lines of credit. So anything that once you pay it, the credit comes back to you is considered revolving. So we know that you're supposed to keep your credit cards, especially under 30%, to maximize your score. But also, they look at installment loans as well. So, and a lot of people don't talk about this. Installment loans, auto, mortgage, student loans, personal loans. Anything that once you got a set payment, and once you pay it off, that's it. Those are what they consider closed-end loans. These are closed-end, and these are open-end. So you got open-end loans and you got closed-end loans. So what they look at in the utilization of credit in installment loans, they looking at what the balance was, what was the beginning balance, and what is the ending balance, or what is the concurrent balance. What is it? Is this balance going down? That's what they're looking at. Is this balance going down? Because they only know that you haven't made a payment if the payment is late. And usually the payment is not going to be reported late until you're 30 days late, right? So they're looking to see if this loan, if this amount is going down. Well, we know some loans front end the interest, right? So it may take years before this actually come down, because if the interest is front loaded, Then it could take like mortgages for one, and then depending on who you got your auto loan with, it could be front loaded. And depends on what type of personal loan you got too. So if you got a lot of front interest that's loading on the front part of your loan, that may take time to pay it down before you actually start hitting the principal, then this may hold your credit score a little stagnant. But because you are keeping good payment history and you're not having any late payments, it's going to outweigh it. Okay. But as that balance is going down, then you will also see your credit score increase. So it's really crazy how credit scores are calculated. But we're going to talk about that in a minute. So we know to keep the payment history good. We know to keep the credit utilization good. So what is number 3? So number 3 is the length of credit. The length of history. I'm sorry, the length of history. So the longer you have credit, the longer your credit is active and being used, and those other 2 factors that I just erased, payment history and credit utilization, is good. The length of history is also factored into your credit score. So that means you want to keep positive debt as long as you can. Now that's why revolving credit gets all the kudos, because revolving credit, you can have it forever and ever, right? Revolving credit is one of those things that you do not have to worry about losing it unless they no longer service the card and the card issuer closes it, or you default. That's it. If you default, of course, they're gonna close it probably. And if they no longer have that card, or the credit card company itself goes out of business or whatever, then that's how you can lose it. But in other words, you can have that revolving line. If none of those factors come in, you can have that revolving line forever and ever. I saw on a forum today where somebody's card got closed. Discover card got closed after having it for 36 years because of inactivity. So it happens. But the length of history makes up the 3rd biggest part of your credit score, which is like 15%. Now, the 4th one is your inquiries. New credit. All right. So inquiries and new credit. You want to be very strategic when you are applying for new credit, because to lenders, if you apply for too much in a short window of time, no matter what your credit score is, you will be denied. Okay. A healthy amount is 3 inquiries and under in 2 years. That's a healthy amount of inquiries. 3 and under in 2 years' time. That's the healthy amount, because you want to keep yourself in a certain scorecard. Now I'm going to talk about scorecards in a minute, but you're trying to keep yourself in a certain scorecard that you do not look at like a risk at any point in your credit journey. Okay. You do not want to look like a risk because of the scorecards. Like I said, I'm going to get to that in a second. So keeping your inquiries low. We know after 2 years, an inquiry is going to automatically fall off. So you should not be applying for credit that often. Okay. You should not be applying for credit that often. So these factors right here, because these 2 right here affect each other so much, because every time you get a new line of credit, you are lowering your average age of credit. I know I didn't spell average right. So you're lowering your average age of credit when you continue to get new lines of credit, because it's kind of they are taking the years of each individual credit product that you have on your credit report, and they're dividing it by the new line to give you the new age, the new average of your credit. Okay, so these two play off each other. Now, number 5 is the credit mix. It's good to have a mixed balance of credit because you want to show them that you are responsible with credit and with all types of credit. So having a credit mix of an installment loan and revolving shows them that you have the ability to handle each type of debt. Okay, so as I was saying, we're going to look at these the scorecards now. Let's look at scorecards. All right, so you have scorecards. Now I got this right now. Now there are different scorecards. Use a different color. FICO 8 has 12 scorecards. FICO 9 has 13. And what are these scorecards? Y'all might not have never heard of that. What are scorecards? So scorecards, they allow the FICO formula to give different weight to the same information. So basically what they're doing is they're grouping people that are alike together. Okay. So if you've ever had a bankruptcy, well, there's a bankruptcy group. So they're going to group all the bankruptcies together. And they're going to study what bankruptcy behavior. So they're going to be looking at all your credit for all the time that you've been having credit and what behavior that you exhibited before you filed bankruptcy. Okay. So they're looking at what your behavior is in each individual group. So with like I was just saying, with the bankruptcy group, they're trying to figure out, okay, because the FICO score, and I told you credit scores in general, are data they're getting to calculate what is the chances of you not paying a debt. That's what your FICO score is. So, but them doing these different scorecards and grouping us based on our activity and our behavior with our credit over time, okay, over time period of us having credit, all right, they are trying to group us in certain categories. So that's what they do. So let me give you an example of a scorecard. So say for instance, you have 3 negative items on your credit report. And you've been building your credit. And you said, oh my Lord, I can't wait for these 3 items to fall off. In 7 years, they're going to fall off. So these 3 negative items can be 2 collections and 1 judgment. Okay, so that's what makes up your 3 negative items. Now we know in 7 years, these are going to fall off if you don't dispute them or try to get them removed before then. Okay, so what's happening? Now say if you did not try to get these removed and you didn't try to dispute anything because these are yours, you know they're yours, but you like bumping, I ain't paying them, whatever, and you just let the 7 years roll out. All right, so after 7 years and they actually fall off, Well, you would think your credit score would go up because the negative things are gone. And if you've been rebuilding your credit and you've been having good behavior all around these three negative things, so you've been paying your current debts, your debts that are active, you've been paying those on time, you're never late, you're keeping your credit card utilizations down, you're doing everything right, you just got these three blemishes that you're waiting for them to come off. So you're thinking, okay, once they come off, your credit score should go up, right? That's logical. But here's the thing. Your credit score could drop 20 points when they come off. And you're like, what in the world? How? Why? How? So if this drops 20 points, you're like, I don't understand. How would that drop 20 points? Because of the scoring cards. Okay. So when you had the negative items on your credit report, you were on a scoring card for people with negative items, for people that had collections, for people that have judgments, for people, you know, like I said, if she had a bankruptcy, she should be on the bankruptcy scorecard. Okay. So you're on the scoring card for people with negative stuff. All right. So because you started paying your bills, you start paying everything on time and doing the right thing, you went up the ladder on that scoring card. So you were other people that's in the scoring card. If you were the only one that started paying their bills and doing what they were supposed to do, then you went up on the totem pole of that scoring card. So your credit will take a hit because now you're going to graduate to another scoring card for people with good credit. So another scoring card for people with good credit. But guess what? You haven't had good credit the whole time. So now you're on the bottom of the scoring card. You're on the bottom of the new scoring card because now you're on the scoring card with the people with good credit, but you have not had good credit the whole time. So now you're going to have to build your way back up to these right here is just completely in the foreground and no longer a factor in your credit score. Because as we know, some things can still factor in like good stuff for 10 years, even after it's gone, because it's closed, you know, but it still can factor in. So now that you're in another scoring bracket, another scoring card, you're on the low side of it. So that's why you took a 20-point hit. So you're going to have to build yourself back up the top of the ladder like you did before. It can be done. So over time of you continuing the good habits, your credit score will rebound. So if you had some negative information, so say for instance, let's look at something else. So we know about the scorecards. Now, depending on where you're at in your credit journey, certain things can cause you more points if you have a higher credit score than if you have a lower credit score. So let's look at those factors. I'm having to change from iPad to iPad, y'all. Let me get to my diagrams. Okay. So let's look at this diagram right here. So we got consumer A, consumer B, and consumer C. All right. And then we got their starting FICO. So consumer A is going to start with a 680. Let me put that in blue. Let's put that in blue. Consumer A is going to start with a 680. Consumer B is going to start with a 720. And consumer C is going to start with the 780. 80. Okay. Now, this is the part where I will say different things can impact your credit score depending on where you are at. All right, so these are the events. So over here, I'm going to put events. So in this side, we're going to put 30 days late on 30 days late on your mortgage. All right, and let's do 90 days late on your mortgage. Let's do foreclosure. And then let's do bankruptcy. All right. So we got 30 days late, we got 90 days late, we got a foreclosure, and we got a bankruptcy. All right. Did pretty good with my table here. I probably can't do it again. Okay, so 30 days late on the mortgage. How would that affect consumer A if they got a 30-day late on their mortgage? So they got a 30-day late. Their credit score is going to go from a 680 to a 600 to a 620. So they've lost either from anywhere from 80 to 60 points for consumer A. All right, consumer B with a 720 is going to go from a 630, from a 720 to a 630 or 650. So we're looking at about 90 points or over 100 points for the 720. Now, 780 over here, consumer C, they're going to drop from a 780 to a 760 to a 690. They took the biggest hit. They taking the biggest hit. The ones with the higher score is going to take the biggest hit. Why? Because of the credit score, the card that I just told you about. When you have good credit and you take a hit of a late payment or whatever it is that you got going on, your utilization and stuff like that, you are getting put into a different scoring card now. You're in a scoring card for people that have late payments. Like I said, it's like 13 in FICO 8 and 14 in FICO 9. So you're in a different scoring card. So they have took you out of the good credit scoring card and put you in the 30-day late. Now, what is the 90-day? 90-day. Same people. All right, so look at that. Consumer A with the 680, it didn't even change. If they did 30-day late or they were 3 months late, it's still going to take 20 points. The one with the 720 is going to drop them to 610 and 630. The one with the 780 is going to drop them to 750 to 670. Bigger drop. Bigger fall from grace, basically. All right, so let's look at a foreclosure. Foreclosure, consumer A. Let's look at B. And let's look at C. Now look at that. So they dropped in a deep subprime. they're in subprime. Well, they're in the deep subprime, and this is near prime. So now they're in near prime, they're in subprime, and they're in subprime. So subprime lenders, they fall between 580 and 619. That's where your subprime scores are. Those are the ones that get all the terrible interest rates and all that. So right now they're in the subprime, and this is near prime. All right. So what about a bankruptcy? So if they were to get a bankruptcy, this is what the credit score will look like. Now, can you imagine having a 780 and dropping down to a 540? But usually, your score gonna usually take all these hits before it gets there. But good Lord, that's a long drop. All of them. Because now every last one of them is in deep subprime. So the higher your score, the lower you fall just 30 days. In 90 days, you're gonna really take a nosedive. In a foreclosure, you're gonna really take a nosedive. And that's because you are being grouped now into a different scorecard. So the different scorecards make up a difference. So if, like I was just saying in the example beforehand, if you were to get out of these different scorecards, let's say you only have that one late, it was a mistake, or for some reason you didn't have the money, you might have been sick or whatever, but from here on out, you pay everything on time. So eventually you will get back into the good card, because what they look at is frequency and recency. So how recent have you been late? The further you get away from that late payment, the better off, because then they're looking at your habit. Because if you had a good prior habit, then you will rebound, and hopefully in 6 months or so, you can get back to 780. But if you get down to the 90 day, that's when the trouble comes, because 60 day in there too. 60 days got to come before 90 days. But just to give you these examples. So the scoring cards is going to matter, because you're being grouped into different categories. Now, one thing you need to know is how FICO works when it comes to length of time. How does FICO work when it comes to length of time? All right, so we're talking about the length of time. What FICO looks at. All right, so FICO says that you got to have one account. You got to have at least one account on your report for 6 months and reporting for 6 months in order for you to have a score. All right. So FICO says you got to have at least one account on your report that is reporting for 6 months. So that means that if you have a credit card, and that's all you got, because you're new to credit, you got one credit card. I say that credit card has $1,000 balance. That's the credit card balance. That's the limit. I'm talking about not balance, limit. That's the limit. Got a $1,000 limit. Now, we already said that payment history number 1 is the main factor that they look at. The next factor is credit utilization. So we know that 30% is credit utilization. And they look at that per card and average of all your cards together. So they average the cards too. Average cards together. But this person only got one card. She only got one account. All right, so that means that for 6 months straight, in order for them to get a credit score for 6 months straight, they have got to pay this card and use this card. Now, here's the thing. If you got $1,000 limit, that's $300. 1,000 times 30% is $300. So, say your due date on your credit card statement. Actually, I'm gonna use my due date. I'm gonna use my due date for my Amazon Chase card. All right, so my due date on that card never fails. It's already around the 12th or the 13th of the month. It just depends on what it falls on. But it's usually either the 12th or the 13th of every month. And my statement cycle ends or closes on the 16th every month. Well, I put the 15th. It just depends on if it falls on the weekend. The 15th or the 16th of every month. All right. So here's the deal with this. If I got $1,000 limit and I only can spend $300 without going over my credit utilization. So say, for instance, that month I decide that I want to splurge and I spend the whole $1,000. Okay. I spend the whole $1,000. Now, depending on between these dates right here, if the credit bureau is going to know I spent $1,000 or not. Now, if I spent $1,000 in the prior billing statement, meaning the month before this was due. So if this is due on the 12th and the 13th, it's probably calculating for the month before. So we're in September. This is probably calculating for my August spend. Okay, this is my August spend. So if I spend $1,000, I probably spent it after the 16th. Okay, because the statement cycle and close date is the date that it actually goes to the credit bureau. So if I'm gonna spend $1,000, if I'm gonna go crazy and spend out the whole limit, I'm gonna do it after the 16th. I'm gonna do it after it reports to the credit bureau. And that's the reporting date. I'm gonna make sure it's after that. So say if I spend $1,000 after August the 16th of last month. And say my bill comes out and I don't pay the $1,000, but my bill comes out and it say I'm due on 12/13. Now, this is the deal. I have to pay this whole $1,000 off to avoid interest, of course, to avoid interest. But say they tell me on $1,000 my minimum ain't but $25. How about say they might say your minimum on $1,000 ain't but $25. And I was like, that's all. So if I don't pay but $25 on that card, of course I'm gonna pay interest, but I'm gonna be way over my utilization when the 15th and the 16th come around, just three to 4 days after. So it just depends on, like I said, it just depends. So 3 to 4 days after, I'm way over. But the credit bureau knows I'm using my card, but that's not what you want to do. So what you want to do is to show that the credit bureau that you're still using your card and avoid paying interest. This is what you want to do. So say if I did spend $1,000, but I did it after the 16th of August. So therefore, the credit bureau don't know I spent $1,000 because my due date comes around. They say, okay, Starr, use $1,000. So I go ahead and I pay the whole $1,000 off so I can avoid interest. All right. So that leaves me at zero balance. So between the 13th and the 16th, 3 days, I have zero balance. But that's not good because the credit bureau won't know I used the card. So what I do is, in order to show the credit bureau that I'm using the card, I go get gas. After this, so on the 14th, I go get some gas. As long as it's under $300, which Lord, I hope it is, if I'm getting just gas, then I should be well under 30% and probably going to be within 10% if it's under $100. Okay, if it's $100 and under, then I'm gonna be 10%, 3%, 4%, whatever, as long as it's not over 30%. So on 14th, I get some gas for about $50. And I'll let that $50 stay on because I've already satisfied the $1,000, so I don't owe any interest, right? So now, a day after, on the 14th, okay, I can get me some gas for about $50, and I'm gonna let that report on the 16th. So when it gets to the credit bureau, they only gonna know I spent $50, not $1,000, but they only gonna know I spent $50. So that's gonna satisfy the reporting. And I can do that every month for 6 months. And then, wow, I'm going to get a score. Okay. Now, with only one account, my credit profile is what they're going to be considered a thin credit profile. It's going to be thin because I only got one account. But because if I rinse and repeat this and continue to pay this card off, if I max it out, make sure that it doesn't hit my statement, because that's the thing. Maxing it out, paying it back off by the due date, not paying any interest. Eventually, the credit card company is going to be like, oh, this person is really good with their credit card. Let's increase their limit so that maybe they'll spend $2,000 next month and pay it back off. Okay. Or maybe they'll spend $2,000 and can't afford to pay it back off and we get some interest. But either way, they'll probably up your limit if you do this for about 6 months. Rinse and repeat, just paying it back off, getting $50 reporting. Now you got a credit score. So then once your limit goes up, then you probably can apply for another card, or if you want to do a mix, like I said, the credit mix, then you might want to see if you can apply for a personal loan or a share secured loan with your bank. Hopefully when you're getting this credit card, you're doing it with your bank. I'm all about relationship banking. So that can generate you a credit score. So how long in order to have a really good score? Well, we know that FICO needs at least 6 months to give you a score. So the best length of time to optimize your score, this was number 3, is at least 24 months. Because why 24 months? Because like I said, it takes 6 months for them to even give you a score. So another 18 months, right, for them to build a habit of what your spending is. Okay, what is your spending habit? So therefore, they're going to group you in the right scorecard. I hope this is making sense. So they have enough time to figure out what your behavior is, especially if you're new to credit, because they don't know anything about you. Okay, so 6 months to get a score, and it's got to be reporting for those same 6 months. You probably got a thin credit profile, but you still need something reporting for at least 2 years so that they have something to base your behavior off of. Because like I said, the FICO score, your credit score, is your risk score, showing how risky you are. That's all it is. So if you don't have a lot going on your credit report, they don't know where to put you. They don't know what category to put you at. That's the algorithm. It's kind of like when you're on YouTube, right? You could be subscribed to a whole bunch of channels, but the ones you look at the most, those are the ones that's going to get shown to you the most, right? So that's what's going on. You could have a buttload of stuff going on your credit report, right? But the things that you do positively is what's going to put you in certain categories, and what you do negatively is what's going to put you in certain categories. So if you like to look at YouTube with credit videos, where they're going to show you a whole bunch of credit videos, you're going to see me, you're going to see the credit guy, you're going to see Sherry, you're going to see the credit plug, you're going to see a whole bunch of us. But if you look at credit like I do, and then I look at true crime, and then I look at a whole bunch of other stuff, so mine is all over the place. Okay, so I might mess up the algorithm. But so they're trying to figure out what is your behavior. So at least 2 years to figure out your behavior. 2 years to start, if you do have any negative items, 2 years to start getting away from the negative things so that you will get into a different scorecard. So that now they're looking at you not at a negative or bankruptcy scorecard or a negative scorecard, or you're in the collection scorecard, or you're in the 30-day late scorecard. You want to be in I pay on time scorecard. I don't match my credit cards out scorecard. My utilization is always good scorecard. Okay. So that's what you want. So at least 24 months. The longer, the better, because what you're doing, you are showing them that you can handle debt for a long time. Because it's not about if you pay your debts off. They want to know how long you can handle paying debt without being late, without maxing your cards out, without doing all that stuff. They want to know how long can you go. So 2 years, I say at the minimum, but the longer, the better. Because then this FICO score has something to calculate the longer you have credit and the longer that you're good with your credit. So last thing, so we talked about the FICO score. Let's talk about some unknown scores that the banks don't tell you about. And you'll never know about these, so they don't talk about these. So let's do this real quick, and then I'm going to get off this live. And I really do hope it recorded. All right. So here are some other lender scores that you may not know about. So I'm going to put these up real quick. We're going up on an hour. All right. All right. So here's one you may not have known about. The application score. Number 2, the arbitration, I don't know if I'm saying that right, score. Let me ask the rest name to say it for me. Attrition. Attrition risk score. I know I probably wasn't saying that right. Then, as I told you before, bankruptcy score. Number 4, behavior score. Number 5, response score. Number 6 is the revenue score. Number 7 is your transaction score. And number 8 is your collection score. Now, this is not an exhaustive list, because as I told y'all, they can have bukus of scores that you don't have no idea that they're scoring you on, right? Because they don't want us to know everything. That's why they give us the top 5. Pay your stuff on time. Keep your utilization good. Keep a credit mix. Don't apply for too much too often. And make sure that, what's the last one? Inquiries. And I said the mix. And make sure you keep it as long as you can in good standing. Okay. So those are the main things. So let's go over these real quick. Application score. This score factors in data from your credit application that's not included in your credit score, such as your income, how long you lived at your current address, how long you worked for your current employers. Lenders usually use application scores with other scores, such as credit, bankruptcy score, to decide whether to grant credit, how much credit to extend, and what rate to charge. So this is your application score, okay? So this looking at your income, your address, how long you've been working, blah, 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 okay? The attrition risk score, Lenders don't want to lose their best customers. So this is what it is. They don't want to lose their best customers. So they use this score to figure out how likely are you to go to a competitor. Ain't that something? Okay. So they use this score to look at how likely are you to dip on them and go somewhere else. And this score is used in a combination with others to help the lender decide what to do next. If your account is profitable and you're seen as a low risk for default or bankruptcy, the company might try to win you back by lowering your rate, boosting your limit, or deloging you with convenience checks. So this is one of them things where if you got like a car that maybe you didn't have forever and they go up on your interest rate, or say they go up on your annual fee, this is the time when you can call them and be like, hey, I've been with you, Chase, forever and a day. Y'all done went up on my interest rate. Y'all charging me an annual fee now. I'm looking at another card that's with American Express. So they might give you a better deal. Like, oh no, we don't want to lose you, you know. So that's what that comes into play. Okay, so bankruptcy score. This credit scores typically predict the chance you will miss a payment in the next 2 years. So that's why the 24 months is so important, because they're looking at what is the likelihood of you missing a payment. And they can't find that out in 6 months or a year, because anything can happen, of course, but usually people are not going to mess up their credit like that fast. They're just getting a score. With FICO, it takes you 6 months to get a score. So they're using this to predict the likelihood that you're going to stop paying entirely and seek to legally erase your debt. So most lenders use both to help assess the risk that you won't pay. So the bankruptcy score is not saying that you already in bankruptcy. It's looking at your behavior to see, are you one of those people, based on prior knowledge and prior data, are you exhibiting those signs of somebody that could possibly file bankruptcy? Okay. Let's look at the response score. The response score, behavior score. I'm about to skip one. The behavior score. Credit scores provide a broad overview of how you're handling all your various credit obligations. Behavior scores, by contrast, focus on how you handle a single account with the creditor who's calculating the score. Do you pay off your balances every month? Do you carry a balance occasionally, or frequently pay only the minimum? That's not information that can be gleaned from a credit report, but the creditor can find this data in its own files. Lenders often use behavior scores along with credit and bankruptcy scores to decide whether, for example, an overdue payment is an unintentional lapse. Maybe you're traveling, maybe you're somewhere that you can't pay your payment, or is that a sign that you might be in serious trouble? So they're looking at your behavior. So that's the reason why 24 months is good, because they always keep hopping about these 24 months, because they need time to gather this data on you. All right, so what about the response score? So only a tiny fraction of credit card offers sent in the mail generate an application. Lenders use response scores to try to boost that tiny fraction of profitability a bit more. Response scores predict the likelihood a consumer will respond to an offer of credit, such as a new credit or a balance transfer offer. Credit card issuers use response scores to decide whom to target and whom to customize offers to appeal to a particular consumer. So your response score is, okay, who's likely to take the bait if we send them a offer in the mail? Or who's likely to take the bait if we send them an email? Okay. So if you're one of the ones that get a lot of offers in the mail, they got you on a really good score, and they're trying to see, okay, where can we put them at on the response score? How likely are them, based on their behaviors and all this other stuff, are them to do more business with us? Okay. That's sneaky. All right. So transaction score. This is a score that run every time you use your credit or even your debit card. So transaction scores compare the potential purchase to your previous buying activity, as well as known to patterns of fraud. So a small purchase followed by a much larger one can be a red flag, because fraudsters often test the card. And I can attest to that. I worked in, when I left the bank this last time to do my thing full time, I worked in the department, and that's all we did. We handled debit card fraud and online banking fraud. And I'll tell you, it's the worst. But they usually do a small amount before they try to do the big thing. So they, with this transaction score, they're trying to figure out, what is your spending habits? How do you spend? Are you somebody that rarely use your debit card, or are you constantly swiping that thing? So that's what they're looking at. So they're trying to see if there is any red flags with that. And also they're looking at false positives. Now it's up to the issuer to decide where to set the bar that triggers account suspensions or review. They set it too high, the issuer can lose too much money, but setting it too low can aggravate customers by abruptly shutting down their cards. You know, you might be somewhere out of the country and you didn't let your bank know, and then you're trying to get something and it's declining. So, you know, stuff like that happens. So they look at your transaction score. So let's look at the last one, and then I'm gonna let you go. Collection score. The scoring doesn't stop after you default on a debt. Collection agencies look for signs that you might be able to or ready to pay. A collection score can help them sort their list of debtors, so the most likely prospects float to the top. The scores look for a variety of evidence that your financial situation may be improving, from better credit scores to another collector's account suddenly being paid. So collection agencies may still be looking to see, okay, they might have been in a bad spot, but are they paying now? Okay, so it's so many different types of things that's going on with our credit that we just got to do what we can do. All right, we just got to do what we can do and not worry about the risk. But to answer your question, Ron, 24 months. What is a good length of history? 24 months. What is what is a revenue score? Did I not say revenue score? Let's go back. Hold on. Revenue score. Okay, a revenue score is all about the money. And revenue scores help lenders guess how much money in interest payments, fees paid by the account holder, and fees paid by merchants and accounts is likely to generate. So they basically trying to see how much money. Hush, lady. Anybody talking to you, Siri? Basically, they're trying to see how much is the likelihood of your account to generate fees, basically. What kind of revenue are they going to get from you? Are they going to get interest? Are they going to get some fees off of you by merchants? Okay, what's the money? Let's get down to the money. So that's what the revenue is. I'm sorry I had skipped that one. Trying to get off this live so you can get to bed. So thank you so much. I do appreciate it. You have a wonderful night, and I will see you in the next video. Good day to all of y'all. I had to come on back on here to finish up what we were talking about last night in the Wealth Wednesday session, because I was already over an hour and I didn't want to keep the ones that was on the live, since we started at 7 o'clock and it was already after 8. So I am up super early this morning. This is Thursday morning. It's about 6:30, and I wanted to go ahead and finish up part 2. I knew it was going to be a lot of information. So let's go ahead and finish part 2. So we talked about what is a credit score last night. Why does it matter? All the different factors that makes your credit score up. Some information you may have known, some information you may have not known. I talked about scorecards and how we are grouped in different scorecards. How many scorecards there are for FICO 8 and for FICO 9. So I'm going to email this part 2, and I'm also going to email part 1 links so that y'all are able to see what we talked about if you were not able to catch the live last night. So today we're going to pick up, I talked about how different debts affect your credit. So we looked at installment loans, revolving loans. We know that revolving is one that you can keep forever and ever. Installment loans are ones that once they are done, once you're done paying them off, like a car, mortgage, you know, personal loans, stuff like that, then they're no longer a factor in your credit score after so many times. Now, if you had good payment history on that debt, then it can stay on your credit report up to 10 years. Okay, so it can still have a weight on your credit score. So today we're going to talk about the cost of bad credit, loan denials, and higher interest rates. So let's look at some data that I had pulled up from the Fair Isaac, who is FICO. They make the FICO score, as I was telling you in a little part of the history lesson. Bill Fair and Earl Isaac are the ones that came up with the FICO score. They established that firm in 1956, and the FICO score has been around since 1989. Right now, depending on your lender, they are using a combination between FICO 8 and FICO 9. And FICO 10 will be coming out. It's already out, but it has not been implemented in all lending institutions as of right now. But because Freddie Mac and Fannie Mae have adapted it, as well as Vantage 4.0 in some instances, I will not be surprised if it is not implemented sometime in the near future. But we're going to talk about that more in depth in week 5 of the Credit Ready program, when we talk about maintenance of your credit and all that type of stuff. But before we can get to the maintenance and all that, we got to get the basics of credit out, so you will understand fully what it is that is going inside of your credit score. It's not just, you're paying your things on time and all that stuff, but you need to know the factors around it and why you can do certain things and your credit score can go up and it can go down. So that's where the scorecards really came in last night, when I was telling you guys that when there's so many different scorecards that can group you in different sections, because they're trying to look at your behavior. So they're trying to let AI, the algorithm or whatever, trying to predict your future behavior based on your past behavior. That's all a FICO score is. They're trying to assess what is the risk of a lender doing business with you. So let's look at the numbers based on this chart right here. So this chart right here will let you know where do you stack up in the average of what FICO is saying, what they see. Okay, so we got 100%, 80%, 6%, 40%, 20%, and 0. Down here on the bottom of this chart is the credit scores. And these are the credit score ranges. So we got 300 to 499, 500 to 549, 550 to 599, 600 to 649, 650 to 699, 700 to 749, 750 to 799, 800 to 850. So surprisingly, I was even surprised when I saw this, that there are more people, 83%, in the 300 to 499 range. So when they are looking at these scorecards, guys, any little thing can get you put in a negative scorecard. So you got to really be careful about paying your things on time. Because as y'all saw last night, if you didn't see, please watch that video from last night first. Depending on where you at in your score right now, the things you do can either make you fall 100 points or it can make you fall 60 to 20 points, depending on how low you are on that totem pole of your score. So if you up here at 800 and you miss a payment, then you probably going to drop 150 points. Versus somebody that's already in the 600s, already in subprime category, they might only drop 20 points. Okay, if they miss a payment, and if they do a 30-day late. Okay, so depending on where you at, how far you gonna fall. Okay, so knowing the data right here of the 300 to 499 category, that just lets us know that there's more people that are delinquent and that are grouped in a delinquent scorecard than there are 1% of people, 2% of people, and 5% of people who have what they call the super prime credit right here, super prime. And then so at 70% is from 500 to 449, but that is still below deep subprime. Okay, that's still below deep subprime. So 50% is between 50 and 550 and 599. So that's a combination of deep subprime and subprime credit. Okay, because we already had said that subprime is where they do the most lending if you have bad credit, and that is 580 to 619. So right in here, it's kind of a combination because it stops at 599 at the 51%. It stops at 599, and then 600 to 649, and that's part of subprime and part of near prime. So 650 to 699, that's near prime. 600, 700, 749, 750, $799. These are prime. And then 800, of course, is super prime. So knowing where you fall in FICO's table will give you an idea of your scorecard. How do they look at you? Your credit score is the risk score, and it's your job to try to be as less risky as possible. So the reason why I set up the Credit Ready program the way I did, first week we talk about mindset, right? We talk about mindset and how you feel about money. What is the talk around money? Do you feel like you have to be in debt or anything like that? Or what might have gotten you in trouble with your credit in the past? So that way we can eliminate those barriers in order for us to be credit ready. Okay, so knowing where you may stack up, it will be the things that you need to do. Now, one thing I like about when you do apply for credit and you get denied, one thing that a lot of people ignore when they get denied is the letters that tells you why you were denied. A lot of people ignore those letters. But in those letters are the gems to tell you what it is you need to do. Because as I was saying, nobody really knows the exact formulas that the algorithm and the formulas are looking for. Because there's so many different scorecards, right? There's so many different scorecards, and you can fall in different scorecards. Okay. If you had a delinquency one time, you may fall into that category, but you could still be in the good credit category depending on where you were at in the categories, right? Where you were at as far as the 1%, 2%, 5%, and so forth. Depending on where you at, you may still be riding in two different scorecards. So knowing that information is how we can do better. So when they send out an adverse action letter, an adverse action letter is when the terms are not favorable or you were denied. Okay, when the terms are not favorable or you were denied. So you will get this from whoever you applied from. On this letter will tell you why you were denied and who they got the information from. So if you were denied from, let's say Navy Fed, since they the most popular talked about credit union right now. If you were denied from Navy Fed, they're going to send you information as far as their internal score. Especially if you apply for a credit card, they're going to tell you what your internal score is with them. And then they're going to tell you what they may or may not tell you what your TransUnion score is. They supposed to, but they may or may not. So your TransUnion score, because that's who they pull. They pull TransUnion on personal. So they may or may not tell you what information they got from TransUnion. And the reason why I say that is because when I applied for the flagship card, if y'all saw my video, when I applied for the flagship card back in April, I was approved for $20,000, but they gave me an 18% APR. And the reason why is because I have a internal score at the time of 303. Now I had only had the account a whole month before I applied. Now, if I had waited 90 days, let my direct deposits and all that type of stuff went in, start using the account, as I tell you guys, the banking relationship, then I probably would have got a favorable interest rate instead of 18%. So they sent me an adverse action letter saying, okay, even though you were approved, it was your internal score with us, because their internal score ranges from 100 to 450. So they were saying, okay, you at 303, which is still pretty good, still pretty high, but they just let me know that it was because of that I got 18%. So whenever you get letters from anywhere that you are applying for, they will tell you why. So if you get adverse action responses like let's see here. You could get adverse action responses like balances too high, too limits. You can also get too many recent inquiries. You could have too many new accounts in a short period of time. Or you can also have too many new accounts in a short period of time. Let me see what else. It's so many of them now. When I'm trying to think about it, it would be like that. When you try to think about them, that's when you blank. Your mind go blank. But let me pull up TransUnion's denial reasons. Let me see if I can Google that real quick. TransUnion denial reasons codes. Hopefully I can get a PDF on that. I know I used this before. But anyway, sounds like I'm not going to be able to pull it up. Let's see, this might be it. I teach you how to read the report. But anyway, balances too high on limits, too many recent inquiries, too many new accounts in a short period of time. It could also, so we know where balances too high to limits. Well, that's probably revolving. That means that you either max your cards out, or you're close to maxing them out. You're definitely over 30%. Let's put it like that. You're definitely over 30% for sure. If they're saying balance is too high to limits. So that's letting you know automatically you are over 30% utilization. Okay. Then it says too many recent inquiries. Well, that's obvious. You've been shopping around for credit. So you got more than the 3 that I told you that's healthy. Going over 3, really 3, depending on your lender, could be too many. But at least no more than 3 in 24 months, 2 years. Okay. So if you got more than 3 inquiries in 24 months. Okay. Now, depending on who you talk to, they may say, well, after 6 months, it no longer have a weight. That is true because it may not have as much weight on it as when you first apply for the thing, whatever it is that you applied for to get the hard inquiry, right? So with that being said, after 6 months, we know that the FICO score looks at things in 6 months increments because it takes 6 months for FICO to even generate a score. We talked about that last night. So in 6 months, it has less impact on your score. After a year, it has lesser impact. By 18 months, it will have almost zero impact. And then, of course, at the 2-year mark, it's coming completely off. So by the year, 15 months, somewhere in there, it's definitely no longer impacting your score because at year 2, it's coming off. Okay, it's coming off. So too many new accounts. So if all of these inquiries, these accounts was actually open, then you may have too many new accounts in a short period of time. This can also make you look risky because a lot of times when both of these two things can make you look risky. Too many inquiries and too many new accounts because based on their data, on their scorecards, say the bankruptcy scorecard, right? They are looking at this data based on past behavior, not your behavior, but past behavior of other individuals. Okay. They are trying to figure out what are the triggers that has caused somebody to go bankrupt, default, go into collections. So they're trying to evaluate what are the triggers. So the triggers can be these things. When your balances get too high on your credit cards, it looks like you may be living off your credit. You're overextended with your debt. Because why? Why would you have maxed out credit cards if you can pay them off? Now, we know that the FICO score does not take into account what you have in your bank account, what your income level is. It doesn't know all that. Those are other internal scores that we talked about yesterday. I listed 8 of them in yesterday's video. So it's going to look at those other internal scores that lenders look at for the other information. I think the income and all that falls underneath the application score. Okay. So it's going to look at those other factors and try to determine, okay, the last people that we have on this chart that had balances that was too high, too delinquent, or they got balances high, did they get into the delinquency rate? Did they fall in whichever category or percentage that they fell in at the time? And this is an average of people that have had high balances. Okay, so that's why your credit score drops when you are over 30%, because you look like you are over extended. You have used too much of your credit at that time. Okay, so they're trying to make sure that you are not living off your credit card. So how will they know? Say if you're on vacation and you take your flagship card, since it's a travel card from Navy Fed. Say you take your flagship card with you on vacation, right? And excuse me, still early, y'all. And you're doing a lot of shopping, you're on vacation, blah, 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 but you have the money in your account to pay this card off when you get back. You have the vacation money set aside in your vacation savings account. You didn't transfer it over into your regular personal checking, but you got the vacation money there. You're not overextended. It just appears to be overextended. Now, depending on when you went on vacation, your statement could have arrived, and then it could have reported that high balance. Okay. But here's the thing. And you probably will take a hit, because if you're over 30% of your limit, then you're probably going to take a hit. But you can rebound from that very quickly by just paying it off and then it reporting on the next statement. Now, depending on how many points it dropped you, you may or may not get the same amount of points back at one time. It just depends. Okay. All these formulas got all these different variables. Okay. So what we think logically does not pan out with FICO. Logic is out the door with a lot of these formulas. Like I was telling you yesterday about the lady, with my example of somebody having 3 collections and was waiting the 7 years for it to fall off. And they thinking, okay, if these 3 things fall off my credit report, then my credit should go up. But it actually went down because you changed from one scorecard to the next scorecard, where she was on the top of the previous scorecard because she was paying on time. She was doing everything that she was supposed to do. But in the second scorecard, she when she went over to the good credit scorecard, her credit score went down 20 points, because now you got to build it back up because you're in a different category now. See, that's why all that stuff matters. When we talk about credit on a lot of our YouTube channels and stuff, we don't get down to the nitty gritty. So that's what the Credit Ready program is so detailed about, is trying to get to the nitty gritty of what goes into all of this, what goes into all of that. And there's a lot of factors, as we see, that goes into that. Okay. So too many new accounts. If you get in too many new accounts in a short period of time, that also look risky. But you'll be like, well, I got approved, so I got pretty decent credit or whatever. But you still look like you might run up some credit and default. You may be triggering a bankruptcy alert. Okay, because you may be running up credit too much, too soon, too fast in a short window of time. Okay, so if you are going rate shopping and you're not being punished for rate shopping. So say if you're going rate shopping for a car or a home or anything like that, where you want to compare rates before you make the decision. Well, they usually give you a week to 2 weeks window of time. Now, the thing is, you're going to still get the hard inquiries. But the algorithm for FICO is supposed to know the difference in your rate shopping and you're just trying to apply for a bunch of credit. So you'll still get inquiries, but you should not get penalized for rate shopping. So say that you are looking for a mortgage, you go to Bank of America, you go to Churchill Mortgage, you go to Wells Fargo, you go to all these different places that got mortgages, but you do it within a short window of time, it will not count. But say you go rate shopping this September, say you're looking at houses and you go rate shopping with Churchill this month, and then you wait a month, and then you let Bank of America pull your credit report, and then you wait another month and let Wells Fargo pull your credit report. That's going to tear your credit score up right there, because you want to do it within a short window of time. You don't want to do it spaced out. So when you are applying for credit cards, same thing. When you apply for credit cards, you want to do those preferably in the same day with credit cards. You want to do credit cards same day if you can. If you already know the credit cards that you've been looking at, then, and you already know what your inquiries, current inquiries are, if you know who the credit bureaus are that are pulling from whatever card that you want, like say you want the American Express card, well, we know they pull from Experian. If you want a Chase card, they pull from Experian as well. And they used to pull from Equifax, so I won't say that they don't, but I know they used to. When I got my Business Chase Inc. card last year, they pulled from Equifax. So when I got another one this year, they pulled from Experian. So we're not going to count them out with Equifax. They may be going back and forth, because as us YouTubers getting information and putting it out here on the streets and the financial streets, and y'all getting it, of course they're going to switch up the game. Okay, they're going to switch up the game because we're giving out some knowledge, and they're going to switch up the game. So don't be surprised if what we tell you has changed. Okay. And as I told you, Navy Fed, they use TransUnion. Let's see, US Bank, they use Equifax. So say you want a card from US Bank, you want a card from American Express, and you want a card from Navy Fed. Well, that's 3 different credit bureaus, right? That's 3 different credit bureaus. So you can take an inquiry on each one of those, and none of them would know. So American Express wouldn't know that you applied for a US Bank card because the inquiry is on Equifax and they're looking at Experian. Okay, Navy Fed will never know that you applied for American Express or a US Bank card because they pull from TransUnion. So it's not like they're looking at all of them. And what I do is I freeze my credit reports. My credit reports are frozen. So if they are trying to be a little sneaky link and try to look at something else, well, I know your main credit bureau is this. And if it ain't, guess what? You can deny me and send me an email. If I'm already a customer, you're probably going to send me an email and say, hey, your credit report is frozen. I need you to unfreeze it. And once you unfreeze it, you can call this number back. Or they may send you a letter stating the same thing. Your credit report is frozen. Once you unfreeze it with this credit bureau, then you can call us back at this number. Okay. So I keep mine frozen. So you're not going to do any sneaky, just in case the information has changed. You're not going to do no sneaky pulls on me, because I may not I might have 4, I don't have 4 inquiries, but I might have 4 inquiries on Experian, and say you're US Bank, and I might not have but 1 inquiry on my Equifax. But if you over here dipping over here and being nosy and Experian, knowing you use Equifax to see my 4 inquiries, well, you might deny me. Okay. So that's why I like to keep my credit report frozen, so that they don't have no chances of doing that. I know what's going on because you're going to tell me what's going on. So that way you're not going in blindsided if they were to pull. Now I'm going to tell you somebody that's notorious for pulling for several different ones, and that's Capital One. Capital One Bank is notorious for doing that. I really don't like Capital One. Capital One is becoming one of my least favorite major credit card issuers. They really are. So with that being said, when you know you are going to be applying for credit cards, I would say once you look at the credit cards and the credit card benefits, because I need y'all to stop applying for cards that you don't need just because somebody on YouTube told you to apply for. Okay, we got to stop doing that. We got to start running up our credit for nothing. Okay, because you want things to age on your report. And in order for things to age, you need at least 24 months so that it will give you the best weight on your FICO score. So the more new accounts you got, the more data, the more this thing is constantly calculating on this formula, because we already know things change on your credit report all the time. Because of revolving credit, for one thing, you're using your card, you're paying it off. You're using your card, you're paying off. Hopefully you're using your card and paying it off. But if you're carrying a balance and the balance is coming down, either way, things are constantly changing month after month after month after month after month. Okay, so you just got to be mindful of that. So when you keep getting credit cards that you really don't care about or don't need, especially credit builder cards, so-called credit builder cards. I don't know if y'all had a chance to look at my new video where I said the worst credit cards. If y'all haven't, I'll probably put that in the email as well. So credit builder cards that usually give a limit around 200 to 700. Now, they might do 1,000, but it just depends on where your credit score comes. But these are like the likelihood of that. And a lot of these so-called credit builder cards, like Premier Bank, Milestone, Destiny, Mission Lane. You know, these so-called, there's a whole heap of them now because they tailor to subprime credit. And if you are in this area in your credit journey, if you're in this area of your credit journey, depending on what part you're in this 14%, if you're in that area in your credit journey, right, you are probably paying way more for credit than you should, because you're in the subprime category and these people pay the most for credit. You're paying the highest interest rate. You're getting the most suckiest of terms. You're getting everything garbage. Now, we already know if you're in the 300 to 499, the 500 to 499, the likelihood of you getting credit is next to zero. But if you do, Lord have mercy, they're going to kill you in interest. So it's very important, because if you're in this category, you are paying more than somebody that is in this category. If you're 680, you got to at least be 680 on this poll, 680. So if you're in 680 all the way up to 850, you're paying less money for the same credit. So you can have somebody with a credit score of 600 and we both getting a mortgage. Well, the likelihood of me getting a better rate than you if I'm over here is very likely. If I'm getting a car and you're getting a car and your credit rating is over here and mine is over here, I'm going to pay less money. I'm going to pay less money for that same credit. But you know me, I like to look at the numbers. I'm a numbers girl. I don't know where I said it at, because I recorded the credit ready presentation videos. But one thing, my favorite motto is this: people lie, numbers don't. Numbers don't lie. Numbers always tell the truth. You can't hide when it comes to numbers. That's why I love to follow the money trail. When we did at the very beginning of the presentation yesterday, when I was telling y'all about FICO and the credit bureaus and the lenders and all that stuff, how I had to give you that money trail, because the lenders order your credit score. We say they pull it, but they order your credit score from whatever financial credit bureau that they use to get your data from. So if your bank uses TransUnion, they're going to go on their portal, and on TransUnion, whatever software they use to get to TransUnion, they're going to order your credit score, whatever score they want, whether it's the FICO 8, if it's the mortgage 2, 3, 4, 5, whatever 245 mortgage number, or your auto FICO score, your bank card score. They got so many of them, I told you. So it's a whole heap of scores out there. So what you looking at on your app might not even be what they looking at, okay? So, but it's good to still monitor it. So don't cancel your subscriptions if you got Experian or if you got My FICO. Now, if you're gonna have My FICO, that's the best one to have, because My FICO or FICO, they Fair Isaac, they the one that make that, they the one that power it along with Equifax. So you want to make sure if you're gonna have one, have that one. That's the best one to have. And then Experian, of course, because Experian use FICO 8. So so let's look at some numbers. I was telling you, okay, the lenders will order your credit score from whatever credit bureau they use, and then the credit bureau will order a FICO score from Fair Isaac. So you got the lender ordering from the credit bureau ordering from FICO. So the lender has to pay the credit bureau has to pay FICO. That's what we talked about yesterday. But guess what? FICO is the end game. The credit bureau and the lender is not going to pay those costs by itself. They're going to somehow funnel that back to the customer. As I said yesterday, they're going to funnel that back to us, the person that's trying to get credit, either in the interest rate, origination fees, application fees, and God knows wherever else that they want to tack on to get that money back, because the credit bureaus, Fair Isaac, they are all businesses. At the end of the day, and your bank is a business, okay? Your bank is a business. That's why I would say even a credit union is a business, but they are a non-profit business. So their money that they make back, they put it in lower interest rates, higher rates on your savings, higher deposit rates on your savings, your CDs, your money markets, and blah, blah, blah. That's how they give money back. And they also put money back into the community that they serve that's around that credit union. That's their way of giving back. So that's why I prefer a credit union over a bank. But I will always tell you, if you're already in a major bank and you've already been banking with them for years and years and years, at least over 5 years, and you might be 2 years, okay? If you've been having your direct deposit going in there, if you've been paying your bills, you've been using your debit card, blah, 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 that's who you need to be doing all your financial banking with. You need to be doing it where your money goes. It makes life so much easier, because they can always just look at your transactions and seeing where your money coming in to determine if they want to give you this personal loan you're applying for, or they want to give you this auto loan that you're applying for, because they already have access to your income. And the likelihood, as long as you kept that account in good standing, not bouncing checks and being in the negative all the time, or being overdrawn all the time, then you got a leg to stand up on, even if your credit is not as favorable, because you have built a relationship with the actual institution that gets your money. Okay, so that's always something that you want to keep in mind. So let me I said I was going to look at the numbers. Let me go in my notes. All right, so I went ahead and paused the video in order for me to put some data points on the board. I hope y'all can understand my raggedy handwriting. So as I say, I like to look at numbers. So these are just examples. We got 2 people. We got Emily and Karen. They both went to college together. And I'm gonna read from this example right here of what they did in their lifetime and what they got as far as their credit scores and the comparison. So we'll know how much do different scores pay for different things. So we have a credit card right here. Oh, there's a glare. We have a credit card right here. We have an auto loan. We have a mortgage 1 and a mortgage 2. Okay, so let's set this up. All right, so for an example, we got both women. They got their first credit card in college and carried a balance of $800 on average over the years. Carrying a balance isn't smart financially, but unfortunately, it is ingrained habit with many credit card issuers. But we, on the Credit Ready program, we are going to work on paying our cards off, and we have debt. That's what we're going to talk about next week, in week 3 of doing the snowball payment repayment plan. So we do have credit card debt. We're going to work on that. And if you don't have credit card debt and you're in the credit ready program, then you will learn some tools to keep you from ever falling into that debt trap like a lot of people do. All right, so Emily and Karen also bought new cars after graduation, financing their purchases with $20,000 auto loans. Every 7 years, they replaced their existing cars with new ones until they bought their last vehicles at the age of 70. All right, each bought their first home with a $350,000 mortgage at the age of 30, and then moved up to a larger house with a $450 mortgage around the age of 40. Neither has ever suffered the embarrassment of being rejected for loan or turned down for a credit card. So they've always gotten approved for whatever it is they applied for. But here's where the similarities end. Emily, which is one, was always careful to pay her bills on time, all the time, and typically paid more than the minimum balance owed. Lenders responded to her responsible use of credit by offering her more credit cards at good rates and good terms. They also tended to increase her credit limits regularly that allowed Emily to spread her credit card balance across several cards. All these factors help give Emily excellent credit scores. Whenever a lender tried to raise her interest rate, she would politely threaten to transfer her balance to another card. As a result, Emily's average interest rate on her cards was 9.9. So that's what I was talking about yesterday with the scorecard. The I can't say the word. It was attrition score card. Y'all know what I'm talking about if you were looking at the live yesterday. Attrition. That's when they're looking at how likely are you to go to a competitor. Okay, how likely are you to switch? So there's a scorecard for that. Okay, and based on your history with them, as this example says, based on your history with them, will they let you go on bye-bye, or will they try to do lower your interest rate, better terms, better rewards, or whatever to keep your business? Okay, so depending on what kind of customer you are to them, whether it be worth it to them to keep you or not, even if you're paying a bunch of interest. Because if your cards is always maxed out, they are really scared, even though they're getting interest out of you every month, they're making money every month, they're scared that you may default. But what did she do? Because Emily had good credit, they got her other credit cards, but she was able to spread out her debt. So say that $8,000 credit card that she had, right? She was able to spread out her debt. So she was if she got two more cards, and say those cards had a limit of $10,000. Well, and then her original card had $8,000. Well, she could take $4,000 off, or she could do what, 2 and 2 and 2. Let's see, no, 2,500, and spread that across those cards. You know what I'm saying? Somewhere in there, might not be exact math, but you know what I'm saying. You got 3 cards. You can spread 8,000 across 3 cards. Okay. So that would lower her debt to, not her debt to income. That will lower her utilization, because if she got $10,000 limit cards now, okay, the utilization on 10,000 is 3,000. So if she moves 2,000, or if she moves 2,500 on there, it's not going to affect her credit score, because she's still under 30%. So that's why you want to go for the cards with the higher limits. Now, if you can't get the higher limits because your credit score is low right now, then you need to wait and build up. Stop being so anxious to get approved and getting low limit cards that don't do nothing but have you stupid annual fees and all kind of dumb fees that they're giving you, and they're only giving you a $500 limit, or they're only giving you a $200 limit. It's not worth your time, because those cards have those $39 or $79 or $99 annual fee that you're going to be stuck with for years and years, unless you close the card within the first year. That way you don't continue with the cycle of paying them money for nothing. Okay, because it's not benefiting you any. So she was able to get better cards that she was able to spread the debt around. So now Karen over here with the 660, by contrast, didn't always pay on time, frequently paid only the minimum due, and tended to max out her cards that she had. That made lenders reluctant, to increase her credit limits or offer her new cards. So when you have your cards maxed out, you're only paying a minimum, they're not offering you anything, okay? Because they're scared. They're scared that you're going to default, because it's like you're living off your cards, okay? That made lenders reluctant. So although the two women owed the same amount on average, Karen tended to carry a larger balance on fewer cards. All these factors hurt Karen's credit score. Not enough to prevent her from getting loans, but enough for lenders to charge her more. Okay, so the cost of credit. Karen had much less negotiating power when it came to interest rates. Her average interest rate on her credit cards was 19.9%. So let's look at Karen, Emily and Karen with the credit card. So 766.60. Emily's interest rate was at 9.9%. Her annual interest cost is $792. Okay. Her lifetime cost of carrying a balance of any was $39,600. That's her lifetime cost that she paid in interest. Okay. This is like over 40 years because they're supposed to be 70 years old now, and they supposed to have started this in college and got the homes like 40, 30, and 40. Okay. So over here, Karen, her interest rate is 19.9. Her annual cost is $1,592. So almost double, a little over double this one. And the lifetime cost is $79,600. So her lifetime interest in the same amount of time with Emily is actually $40,000 more than what Emily spent with the same cards, with the same credit, with the same, not credit, activity. But just the behavior is different. What Emily did and what Karen did, Emily paid on time. She never was late. She would pay her cards down. She was able to get other offers to spread debt across the board to keep her utilization down. She didn't have fewer cards, maxed them out, and mostly paid the minimum payment. So that's why she paid more for the same thing. All right, hold on. So Emily's careful credit use paid off with her first car loan. She got the best available rate. She continued to do so every time she bought a new car until her last purchase at 70. Thanks to her lower credit score, Karen's rate was 3%, was 3 percentage points higher. So with an auto loan, she was able to get her auto loan at 4.25. Her payment was only $371. Her interest cost over the annual is $2,235. Her lifetime cost was $17,880 for the life of the loans. Now, the same thing, Karen, her interest rate was 8.25. Her payment was $408. Her annual interest cost was $4,475. Her lifetime cost was $35,804. She paid $17,924 more than what Emily paid. Okay. So let's look at the mortgage. So Karen's penalty only grew when the two women moved up to larger houses over the 30-year life of their mortgage. Karen paid $100,000 more in interest. So let's look at the first home. Emily got 4.38%. Her payment was $1,749 a month. For the 10 years that she had this first home, she paid $139. She paid $139,057 on interest in those 10 years. Now, Karen over here, she had an interest rate of 5.38%. Her payment was $1,961. She paid in the same 10-year period $173,222. She paid $34,165 more than what Emily paid. So they could have been in the same subdivision because, like a lot of these subdivisions look exactly the same. They could have been in the same subdivision and yet paying significantly different amounts at the end of those 10-year periods. Okay, so they sold the houses. They did an upgrade. So their new house cost $450,000. So this is the last home for them. So Emily was able to keep the same interest rate. So it's Karen. She was able to keep the same interest rate. So on this one, 4.38, her payment was $2,248. Karen, her payment with the 5.38 is $2,241. Now her payment is $7 less than Emily's. Okay, but this is over 30 years. So they got this home at 40. So they got this home at 40 for $450,000. So the interest that paid in the 30 years, this is 30 years now, was $359,319. The interest that Karen paid in the same 30 years, same house, same cost, $406,807. She paid $98,338 more for her house than Emily paid for her house. Okay, so that is the cost of having bad credit. When you are in the subprime category, okay, when you're in the subprime category and near prime, because she's at the near prime category. Okay, she paid significantly more money for everything, from credit cards to auto loans to her mortgages. She paid more money than Emily that was doing the exact same thing. So we got to stop trying to just be approved for things and look at how much it's going to cost us over time if we carry a balance on our credit cards. Because a lot of y'all, you get your credit card statement and you don't even look at that part where it says, if you only paid the minimum balance, how long would it take you to pay this card back off? Pay that some attention the next time you get a statement. If you are just paying the minimum, pay that box some attention going forward, because it's a requirement now to be on all credit card statements that you have to put the truth in how much the debt is going to cost the customer. So if you got a $2,000 card that you maxed out and you're only paying a $25 minimum, it's going to break it down and tell you, okay, it's going to take you 20 years to pay this card off at 20-something%. It's going to take you 20 years to pay it off. And I'm not exaggerating. A lot of them say that, or either 4 years. So if you bought a pocketbook that was $100, or if you went on a vacation that was $1,500, you will pay for that vacation and 3 more. Okay. All right, so we got to look at the numbers. Like I said, people lie, numbers don't. So this one is going into an hour or two, but it was just so much to cover. So you just want to make sure that you're not paying more than you should. So we got to pay attention to the factors that goes into our credit scores, because there's so many of them, we really don't know what they are looking at. You know that the basic 5, we know that the main 5 that they're looking at, the main top 5 things that you can do your very best on, your very best. And that's the main one is your payment history. You cannot have late payments. Okay, you cannot have late payments if you're trying to be credit ready and you're trying to keep your credit score as high as you can get it. Okay. So you got to make sure you pay these payments on time. If you got to set your payments on auto minimum payment, that's what you need to do. Auto minimum. So on your credit cards, you can set it up on automatic pay that it will pay the minimum, and you can always go back in and pay an additional. But the minimum will be paid regardless of whatever. I hate this glare skin on my nerves. It's going to be paid regardless of whatever, the minimum. So set that up on minimum. Okay. If you have an auto loan and your check goes direct deposit into your bank account, and hopefully you have your loan with the bank that your money goes in, that's the goal. You can have them to auto draft your payment on your car. This is credit card. Okay. If you have a personal loan and your payment and your money goes direct deposit into the bank, and you got your personal loan with the bank, same thing. You can auto draft that as well. You can set it to auto draft every pay period. Like, you can split it up. So you got a $500 car payment. You get paid every 2 weeks. You can pay that car payment every 2 weeks at $250 and split that $500 payment up. Not only will you be paying it often, you will pay less interest because you're paying it more often. It doesn't have time from month to month to recalculate. Okay. It's only recalculating only 2 weeks versus a whole month. Okay, from the last time you made a payment to the next time. If you pay it more often, you pay less interest and you'll pay it off faster. Okay, so when I worked in the credit union, I had my cars. When I still was paying on my cars, I always paid it more than once a month. I paid it every time I got paid. Okay. So that's a good way to pay it off faster, and you save on interest. So anything that you can do auto, I recommend you do it auto in order for you not to be in a financial situation where, you know, life happens. You might forget, especially if you have a ton of cards like I have. I have a ton of credit cards. I do. I have way more than I need. And because of that, I have to keep things on auto. But I don't have high balances. So whatever that's coming off of those credit cards is probably a streaming service that probably is less than $10. Well, I know I got $10 in my checking account, so I'm not worrying about anything being returned. So you want to at least, if you know you got these things on auto, especially like if you got a lot of credit cards, you want to at least keep $200 at all times in your checking account as a cushion, especially if you don't keep up with it. Okay, especially if you don't keep up with it. This used to be 100, but because of inflation, I had to change that up to 200. So let's make sure that we're keeping at least a $200 cushion for these automatic payments if you're not keeping up with your due dates and when things are coming out. Okay, if you're not keeping up with it, but you should keep up with it because it's very important so that you don't get in trouble and miss a payment by mistake. Okay, so that's number one. Number two is the credit utilization. And I talked about this yesterday a little bit more. We know that we got to keep our credit utilization under 30% when it comes to revolving lines of credit. That's your credit cards, your overdraft protections, that's your credit cards, your overdraft protections. That is your HELOCs and your PLOCs. You know, your personal lines of credit, your home equity. Y'all know what I'm talking about. So anything that if you pay it, that they give you a line, you pay it back, whatever part you spent, that line comes back. These are open-ended loans, open-end, okay? You want to make sure that you're paying those and keeping them under 30% of whatever that limit is. So if it's $1,000, we are keeping it under 300 because 1,000 times 30% is 300. So we're trying to keep it under 300 if it's going to go to the statement. Okay, I talked about that, so make sure y'all looked at the video on because I go a little bit deeper into that using my own credit card as an example. So we want to make sure that we are keeping these utilization down. So if your utilization right now is too high and you can't pay it back down under 30%, then you definitely need to be a part of next week session when I actually go over that thoroughly. Okay, so if you're having trouble right now paying your credit cards off and don't know where to start at, or any type of loans or anything like that, you don't know where to start, you definitely need to be in next week's section for the snowball effect. All right, so let's look at the other ones. So length of history, 4, credit mix, 5, this is going to be new credit. All right, so the length of history, make sure that we are getting things. If you're going to get a personal loan, don't let it be less than 2 years. See, no less than 2 years. Because FICO needs reporting on anything that you get for 6 months minimum to calculate a score for you on that product. So it's got to at least be 2 years so that it will be able to calculate an accurate score and get an accurate behavior on your spending and what you do as far as paying your bills. So I would say no less than 2 years. So if you're getting a pledge loan or any type of installment loan or whatever, don't get it for less than 2 years. Okay, so that it can actually give you a good impact with your credit behavior, paying it on time, blah, blah, blah. All right. So making sure that we are keeping our length of history long so that lenders can see that we know how to handle credit for years and years and years and years, right? Especially if your credit has taken a hit with bankruptcy and late payments and collections and blah, blah, blah. We gotta get as far away from that negative stuff as possible and start with nothing but the good going this way. So if negative is right here, we want to be positive. We want to keep going as far away from this, as far as way we could get out of this, because the longer, the further away you are from whatever negative event, it will not have a higher impact in the future, as long as you keep doing right going forward. Okay, as long as you're doing right going forward, it will negatively impact you less and less as the positive is steady going forward. Okay. All right, so credit mix, we know that to have a healthy credit mix, that's gonna include revolving and installment loans. So if you have a credit card and say you have a student loan, okay, you got a student loan is an installment loan, or a credit card is revolving. If you have a mortgage and a credit card, we know that's both categories. So that's what it means by credit mix. You're just showing that you can handle different types of debt: mortgage, personal loan, car loans, credit cards, overdraft protections, HELOCs, all those different types of things that fall under those different two categories. They just saying that you know how to handle those different mixes. Now, you don't have to have a ton of bunch of these going on. Like me, on my credit report right now, I only have credit cards and student loans. I don't have any car payments. I don't have any personal loans. But they say that I have a excellent mix, because I've had personal loans, I've had car payments that I've paid off. So those things are still factored into my credit score. So you just want to make sure that you are keeping a good credit mix, because that do count on your credit score. All right, new credit, we already talked about that. We want to make sure that we keep those inquiries under 3 for a 2-year period, if all possible. Okay, because people that have the highest credit score request money less than people that have lower credit scores. So people with a higher credit score, they borrow less frequently than people with lower credit scores. So we want to make sure that we keeping those inquiries low, and we're only taking out new credit that we need. And not because Starr on YouTube says, oh, there's a new credit card on PenFed, y'all can get it. Okay. I call myself out, but I like to give information, but that don't mean that you need to take it. It's just informational. That doesn't mean that you need to apply for the card, okay? Or if you see Sherry or Mike the Credit Guy or the Credit Plug or any of us, okay, they're just giving you information. It's okay to look. That don't mean you need to apply. So you just need to do the things that you need. What is financially a good fit? Okay, that's what we want to do. We want to do stuff that is a financial good fit for us. So if you're looking to get a new credit card, it needs to have a benefit other than Starr said, this credit card, I can get it easy. Okay. You want to look at things that's going to benefit you, that's going to be a good fit. So if you're looking at getting a new credit card, what is your purpose and reason behind that credit card? Is your job going to be having you to travel? So you might want to get a good travel card. Okay. Have your grocery expenses went up, or your kids eating a whole bunch of food. So you might want to look at a card that has, good food rewards or good food cash back or something like that. Or say you drive all the time and you want a card with good gas points or good cash back on gas and stuff like that. So look at cards in that light. How will it benefit you by having this card? Because what we want to do, what we're trying to get to, is not giving the credit card companies any money, but getting all the money. That right there will help offset inflation for you. Okay. So if you got a card that's giving away, like say for instance, the flagship card, I think if you spend $4,000 within, I think it's 90 days, I'm not sure, but just say that, okay, for sure that you're going to be, for sure that you're going to be doing a lot of traveling for work, right? And they don't give you a corporate card or any type of card for your travel, but they will reimburse you for your travel. So if you got a card like the flagship card that only has a $49 annual fee, okay, then you can use, not percent, but fee, then you can use this card as a travel card to get the points, to get the rewards, right? And then you know you're going to get reimbursed by your job for that travel, okay? You're paying this card back off. You're getting the rewards. You're not paying any interest. That's the goal, okay? And even if you're not traveling for your job or whatever, still, if you're just getting food, okay, you know you're going to buy groceries anyway. So use the card to buy your groceries because that's something you're going to do anyway, all right? So if you're using the groceries, the food to buy your groceries, then you're going to pay that back off with the money that you have in your account. Don't use the credit card and keep your cash, okay? Don't do that. Pay the card back off with the money that you was going to use anyway, okay? So we're going to talk about setting up an emergency fund in week 4, but that's going to really tie in with helping you making sure that you are only getting things that you need and not relying heavily on your credit. But next week, we're going to talk about the debt snowball effect and how that is going to help us, that the ones of us that are in debt, to help us get out of debt. I really do hope that y'all enjoyed week 2. This was a long one. It's so much to cover. That's why we're going to talk about even more in week 5, where we talk about maintaining our debt. We're going to talk about FICO 10. We're going to talk about all the new changes that might be coming our way and how it's going to look at your credit going forward if that is implemented. So once again, I really do appreciate y'all, and I will see y'all in the next session. Hopefully y'all will be able to be a part of the next session next week. Peace, peace, peace.